When most people think of student fundraising, they picture a few coins dropping into a jar from a big sale or a car wash. But as this chart of annual revenue demonstrates, associated student body funds at large high schools operate on an entirely different scale, often bringing in millions of dollars a year. By definition, an ASB consists of funds raised strictly by current students to be used for the benefit of current students and held at that specific school site. Because these operations rely heavily on decentralized, physical cash transactions across dozens of campus clubs, the risk of human error and active fraud is exponentially higher than it is with standard district wire transfers. Under the law, these are public funds, operating under the school district's tax identification number. Mishandling these funds, even through well-intentioned ignorance, constitutes a breach of fiduciary duty. The legal consequences for school administrators are severe. Protecting your career and surviving an audit requires mastering 3 architectural layers. First, legal governance. Second, entity separation. And third, rigorous internal controls. The first principle of ASB compliance is understanding that school districts are not legally required to have student bodies at all. Their existence is a privilege granted solely by the governing board. California Education Code 48930 serves as the absolute legal bedrock, granting the governing board authority to form and regulate these student organizations. Further down, Education Code 48938 splits that authority into a strict governance spectrum, separating elementary programs from middle and high schools. At the elementary and TK-8 levels, we find unorganized ASBs. Because the younger students do not govern themselves, the principal holds complete legal responsibility for oversight and financial decisions. This organizational flowchart maps out the contrast. On the left, the top-down, unorganized structure. On the right, organized ASBs for middle and high schools require an interconnected web of autonomous, student-driven decision-making, including formally approved constitutions, elected officers, and documented meeting minutes. Adult advisors cannot make financial decisions on behalf of organized ASB students. The students themselves must direct the spending. Failing to align your school's operations with the correct side of this government spectrum guarantees an immediate audit failure. Your entire legal authority to spend money rests on executing this structure correctly. The most common and dangerous auditor finding in school finance involves treating the ASB account as a pass-through entity or a principal's discretionary fund. Campus finances contain 3 distinct entities: district general funds and ASB funds sharing one tax ID, and school-connected organizations holding a separate tax identification. The absolute rule is you must never commingle ASB funds with independent 501c3 organizations like PTAs or boosters. Because boosters and PTAs are separate legal entities, they cannot use the district's tax ID. They can donate money to the ASB, but once deposited, the PTA loses all authority. Only the students decide how to spend it. The second rule of separation dictates that you must never use the ASB account to hold standard district revenue or adult staff funds. Library fines, AP testing fees, and staff coffee funds are prohibited revenues that incorrectly end up in student accounts. Any breach of this separation, even for temporary administrative convenience, triggers tax status violations and compromises the overarching financial integrity of the district. When deciding how to spend these funds, every transaction must pass a strict objective test. Does the purchase directly promote the general welfare, morale, and educational experience of a group of students?
There is a clear legal boundary between an extracurricular enhancement, which the ASB can fund, and a standard educational requirement that the district is legally obligated to provide. This T-chart maps the dividing line. On the left, allowable expenses. Athletic officiating, social events, and equipment like telescopes directly benefit students. On the right, prohibited expenses. Teacher salaries, building maintenance, and standard curriculum supplies are district responsibilities, not payable with student funds. Administrators must also guard against the ultimate compliance violation, authorizing a gift of public funds. Purchasing employee appreciation gifts, buying adult staff clothing, or handing out undocumented cash awards to individuals all fall into this prohibited category. Spending student money on adult responsibilities or individual gifts constitutes a severe misappropriation of public tax-advantaged funds. Independent auditors actively hunt for internal control failures in these accounts. Campus compliance is dictated entirely by the tone at the top, set by the principal. For organized ASBs, there is an absolute legal mandate. Absolutely no funds can move without documented prior approval. This diagram illustrates the triple approval protocol. Before any purchase order is executed, it must secure 3 distinct signatures: the student representative, the advisor, and the principal. Furthermore, those 3 signatures must be supported by formal, documented student council meeting minutes, proving the students actually voted on the expenditure. Physical cash controls demand the same rigor. All cash must be immediately deposited in a safe and secured. It can never be left in a desk drawer or taken home by an advisor. After any fundraising event, the chain of custody requires a double counting protocol, where 2 individuals physically verify the totals together before the deposit is logged. Under no circumstances can you pay for event expenses or reimburse volunteers directly out of undeposited cash receipts. This line graph highlights another hidden danger: excessively large ending fund balances. When accounts accumulate excess money year over year, it triggers a fraud alert for auditors. Hoarding funds violates the core principle that money raised by current students must be spent to benefit those exact current students. It also creates a massive temptation for internal fraud. Internal controls are not bureaucratic red tape. They are the only verifiable mathematical defense a principal and advisor have when faced with accusations of financial impropriety. Strong internal controls protect innocent staff and students from false accusations by providing a verifiable record of all transactions. To enforce this, governing boards must establish comprehensive, uncompromising policies regarding ASB operations. The Fiscal Crisis and Management Assistance Team, or FCMAT, provides the state's standardized framework for these operations. By formally adopting the FCMAT ASB Accounting Manual into board policy, a district transforms these best practices into official, enforceable regulations that auditors use to verify compliance. Districts must pair this with documented, mandatory annual training for all principals, advisors, and bookkeepers to eliminate the excuse of administrative ignorance. ASB programs are powerful tools for teaching students practical business logic and leadership, but they operate within an unforgiving legal reality. Treating student funds with the exact same rigor as corporate compliance is the only way to safeguard the district's reputation and your career.